As we head into bank earnings, there's a phrase you're probably going to hear a lot of. It is net interest margin. So we want to tell you exactly what that means. It's the difference between the interest that a bank pays out and what it brings in. So in other words, a bank takes in deposits from you, from companies, and it pays interest on those deposits. So that's the money that it pays out. Then it also loans out money to you, for your home, for example, to businesses, and then it collects interest as a result of lending out that money. The difference between those two numbers, that is commonly referred to as net interest margin. So in other words, if I'm depositing my money in the bank and collecting 3% interest on that, and then also if I am borrowing money from the bank for whatever it may be, and I'm paying 7%, say, on that loan, the difference between those two, 4%, that's the net interest margin. But to get a little wonky for a second here, the technical definition then takes that number and divides it by the average earning assets at the bank. All that means is all the other stuff on the balance sheet that doesn't really move around that much, stocks, bonds, etc., that's where you get the net interest margin. It's also especially relevant right now with a period of rising interest rates. Why? When interest rates start to go higher, more people want to put their money in savings at the bank because they're getting actually some interest on that for the first time in a long time, and maybe fewer people want to borrow money because it's more expensive to do so. So it's particularly relevant right now, and we're going to hear a lot about it once the banks start reporting.